And what's up, Garrett? How you doing, man? Welcome back to the channel.
Hey, Nick. Happy to be here. Excited to talk three things today.
Yeah, so the S&P 500, a little bit of a interesting place recently. Well, just the U.S. indices in general. I was hoping to get your reaction here to yesterday's inflation numbers, hotter than expected. I saw on your story that you had posted polling the audience, and people kind of were like mixed about it at first, but then, of course, we saw the numbers come out. Inflation was really hot. So what was your reaction to those numbers?
Yeah, so definitely, a big number yesterday. My
It was
reaction was,
7.5% year over year. Is that
yeah,
right?
so year over year was 7.5. I believe the expectation was 7.3. So hotter on that number. And then the month over month number, I believe it was a point six read versus a 0.5 expected, something along those lines. So on both sides, the number was hotter than expectations. And then the other kind of interesting thing, if you actually read through the number itself, if you excluded food and energy, right, the number was still super hot, which I think is super important because food and energy are typically the more volatile, aspects of that read. So I think it just goes to show that generally inflation is hotter than expected, which, as your viewers probably saw, and as everybody that was watching saw, the stock market ended up dropping, and
Sure.
ended up being,
Sure.
consequential there.
Yeah, and so just to recap for people who are just catching up on everything. So inflation came out hotter than expected, as Garrett talked about. The stock market initially dropped, it whipped around for a little bit, but then ended the day kind of bearish. And still, overall, the market is it's trying to recover, but it's still struggling. And I think that it's reasonably struggling because the Fed is still remaining quite hawkish on things. And as long as that story stays strong, that just puts pressure on, borrowers, which is a lot of big tech companies and things like that. So I want to see, in terms of your perspective, you've got your chart pulled up here. So you're looking at the SPY here. What's your thoughts in terms of the S&P 500 and where we sit in reaction to this?
Yeah, absolutely. So I think if we start by, taking a look out, right, we were in an uptrend for a very long time, essentially since the, coronavirus recovery started back in, I guess it would have been, close to April of 2020. For a while there, we were really kind of bouncing off of this trend line up here. And then essentially we get to the November area here. And that's where, the Omicron wave hit, right? So you start to see the uncertainty coming in here. And then ultimately, around the beginning of the year is when all of the, really hawkish Fed signals started to come in. So you started to see kind of the uncertainty of Omicron combined with the Fed. So that's just to kind of set the stage here as we kind of look at the shorter term. So shorter term, I think if we go ahead and switch to the 4-hour here, I think that there's a couple of key things to consider. So I think one, it's going to be really hard for the market to, generally speaking, make any sort of large moves up in the short term, right? So, there's a lot of uncertainty. I think that to an extent, the market has priced in a rate hike from the Fed. But I think what the market doesn't have a good handle on is what, to what extent is the Fed going to hike, right? Is it going to be 25 basis points in March? Is it going to be 50 basis points in March? Is it going to be, and sometimes, you don't see this very often. I think the last time this happened was like 2000, but sometimes you see like an intersession hike, right? Where they do a rate hike in between sessions. So, that could be a huge factor on the market if that ultimately ends up happening.
Sure.
So I don't think that you're going to see the market trade higher in the short term. And then I think if you look here, there's like a little double top here on the, 200-day moving average. So I think, if I was to predict, I think the market could probably move lower back to this area, in the short term. And then I think you could see a bounce around the 430 area. And again, for the viewers, this is SPY, but if you guys are trading the S&P 500, it's really the same exact chart. But yeah, so I think you could see a bounce in this area. And then I think what's really important, again, is as you move into March, there's still going to be a lot of uncertainty. So I think if you do see a bounce off of this area going into March, I think it might be kind of short-lived as we approach that March 10th date and see kind of what the February CPI number looks like, which I think will most likely, impact whatever happens on the 15th when the Fed kind of have their monthly meeting to decide if they're going to raise rates, which they should.
Right.
So,
And you kind of putting everything together, you had really strong jobs numbers. You had inflation red hot. You have the Fed making it clear that they want to do what it needs to do to get things back to a normal inflation level. People debate whether or not that's the Fed has the ability to do that. I know Frank and I had been discussing just recently about, Frank thinks that, even a 25 basis point or 50 basis point, it's still, it's going to take a while to really start curving off that inflation, which you put that all together. That concern and the willingness from the Fed to want to raise rates and to combat this, I think personally, I'm kind of with you. I think it puts a damper on stocks and just in general, the indices. It's not that I'm overall bearish, but this would be about the closest to bearish that I could be in terms of, I don't short the markets, but the closest I could get to that,
Yeah, and I'm in the same boat. I don't short the markets either. Generally speaking, I have a pretty long term, view. So
Right.
I'm obviously bullish on stocks in the long run. But yeah, I think like to me the biggest thing is, I think over the next 6 months we're going to see the Fed have to do this insane maneuver to essentially hit. I think some people call it like a smooth landing of, okay, how do we stop what we're seeing with inflation without creating some sort of recession, right? Because if they hike rates too quickly or too much, that could put too much pressure on the economy and then ultimately trigger some sort of recession. But I'm not saying that that's going to happen, but there's a non-zero probability. And that's basically, if you look back in history, like the 1970s, ultimately that's kind of what happened is the Fed basically, from political pressure, decided not to raise rates when inflation was going higher, and then ultimately had to come in later and raise a bunch, and then it kind of triggered a slowdown in the economy. I think the Fed still has time at this point, to get those rate hikes in and slow things down, but it is a risk. So I think it's interesting to think through that moving forward.
Yeah, and we've seen ranging predictions in terms of the Fed's willingness to raise rates. I think Goldman Sachs was saying 5 rate hikes this year, which is aggressive. That's a serious, and there's a reason why the dollar in general is so strong right now. The dollar, sure, in the short term, we've seen the dollar be a little bit mixed, but overall, the dollar, just show my screen just for a second. Here's a daily chart of the US dollar, and you can see the dollar just, reigning strong. Now, just for a little bit of the audience sake, sometimes it's confusing. People are like, if inflation is so high, why is the dollar rising? But remember, it's just a race among all of the different currencies. If you're a currency trader or currency investor, whatever, remember that you have to park your money somewhere, and currencies are all based relative to one another. So when we look at the dollar, it's being valued against other major currencies. And when we see other central banks being less hawkish or behind the curve in terms of what the Fed is willing to do, that makes the dollar relatively strong compared to some of the other ones out there. And so going off of Garrett's points about, the Fed just being or trying to balance that between the recession and trying to deal with inflation, the hawkishness overall still sort of reigns supreme, and the dollar is still very, very strong overall. Garrett, do you have any other, so you're looking at the SPY, are there any other markets that you're looking at right now? And if so, are you looking to buy stocks at a discount? What's kind of your approach within this atmosphere?
Yeah, so my personal strategy is typically around individual stocks. So I don't typically trade the indices like too heavily, but yeah, I mean, generally speaking, if I kind of have like what I call a shopping list of things that if they were to pull back, I would like to get into. So I think at this point, I feel like technology is still a pretty good opportunity here, especially if you see things continue to move lower. And that's what I was going to pull up here. We can take a look at, the QQQ, which tracks the NASDAQ. And I think we can see that it's behaved very similarly to the, S&P 500, but the moves have been larger, right? So, you can see that, overall peak to trough, was a, larger, I guess you could say, drop, and it's still trading beneath the 200-day moving average here, which, isn't necessarily a good thing for the short term. But yeah, I mean, I think generally technology stocks, I think, the market's forward looking. So I think the trades that, people have been benefiting from, including myself, around like financials and, commodities, I think eventually that's going to end. And I think at that point, I think you'll start to see some rotation back into tech. But I think we have to get through this uncertainty with the Fed and really get some more information there before we have a good idea of what the rest of the year is going to look like.
So what would that, in terms of an entry, right? Would you be looking for a certain price point, a rotation in terms of stance from the Fed, or a combination of both? What are you thinking? Like at what point would you say, okay, QQQ goes down to a certain point or it breaks out of a certain level? How would you chart wise say like, okay, this thing looks solid again?
Yeah, so I think for me, I think similar to SPY, you could probably see, let me see if I can get some arrows here. I think you could probably see it kind of come back down here and retest this prior level down here and then potentially get a bounce. I think for me to feel good about things moving forward, I think if we were to see, a bounce off of that level, and then ultimately, if the 200-day moving average came lower and we were to then bounce higher and ultimately go above that 200-day moving average,
Sure.
I think it would make me feel better. In addition to, the fundamentals and like the macro stuff going on, right? Like if we got more data with the Fed, I think it would make me feel a little bit better. But ultimately, it's going to come down to, the number of rate hikes. That's going to put a damper on technology. But yeah, short term, I could see, potentially something bouncing off of here. And then if it moved over the 200-day moving average, you could see some momentum.
Sure. Well, and one thing historically too is that there is such a thing. It's a very delicate balance. There is such a thing as, of course, rates going up, but so is the market.
Right.
I believe that before 2020, they were raising rates, not aggressively, but they were raising them. We were at, I think, 2.5% or 2% prior to 2020 before they cut. But they were raising rates, and the markets were still kind of overall moving higher. So it's not impossible to, use some of the fears from the Fed's stance to perhaps like look at stocks and find indice bounces off of lows and things like that, and taking advantage of some of the short-term fear that can cause, and still knowing that despite, a little bit of Fed pressure, the stocks that you're potentially buying are still strong companies, and they're not going to roll over and die from rate hikes. Now, of course, there are some companies that very much could. And to that point, actually, when we look at indices, some may drag down the indices that are, more debt heavy, less productive. But then, as we mentioned in our last segment, I believe last week, we talked about, profitable companies will survive and do fine. And so perhaps that's where you could look at some individual stocks, or if you're looking at something like the Dow Jones or the NASDAQ, if you're tech heavy, you could kind of pick and select something off of good technical levels. And I think there's still some potential to do fine.
Yeah, no, I think it's a great point that people have to keep in mind, right? Like if we think about where we are, relatively speaking, right, with, where interest rates are, we're still, far below anywhere scary, right? I mean, I think the Fed, I don't even remember what the target rate is, but it's not that much. Like it's probably somewhere between 1% and 2% is probably what they're targeting. So it's really not that bad. And yeah, like the QQQ, if you're trading the NAS100 indice, obviously that's a basket of stocks, but it's weighted, right? So you've got like the bigger companies that have a higher weight, and generally those companies are, they have more cash to work with. So, I think amongst all the doom and gloom talk, I think that there's still, a lot to be, excited about with the market, and especially over the long term. I think as the market works through this period of uncertainty, generally speaking, that's a good thing for the market. Even if, whatever the Fed says is, not necessarily bullish, I think the market still benefits from just more data to work with rather than uncertainty.
Interested in seeing our trades live as they happen? By joining the A1 Trading Discord, you'll get a notification every time one of our traders enters a position. Each trade we share comes with an entry price, a stop loss, and most importantly, a full breakdown of why the trade was taken. Learn alongside our experienced traders, join our active chat room, and ask your questions in our coaching webinars. Between our team of active traders, we trade forex pairs, commodities like gold and oil, crypto, and stocks. By joining the group, you'll be able to keep up with all of it. Sign up today using the link in the description, and don't forget to use our promo code listed below for a special subscriber discount. Thanks for watching, and see you inside.